Good morning, traders and investors. It is Thursday, October 9th. Taking a look at the charts. Let's take a look over the equities. They're a little mixed this morning, pretty much flat. We've got the NASDAQ, Dow, Russell slightly lower, NASDAQ slightly positive. Market taking a bit of a breather. We've ping-ponged around again above these. We had a little bit of FOMO the other day. We had a quick little pullback from that, and then we got into this little bit of panic selling, and then of course that had the bounce yesterday we talked about as we poked to some nominal new all-time highs, and the market's just trying to figure itself out. As you can see here, if we look on the daily chart, we have the market kind of doing it's not an ugly chart pattern, but it's kind of doing a bit of a running correction, and we're just kind of letting it run up this 5-day moving average. We have had this, when we look at this price action, we had a rally up, it's had a cleanse, and now it's just trying to get some traction, and it could pop and squeeze higher, or we might see it want to come back down and test the 20-day and maybe do another kind of little wave of cleansing there. So we'll just have to see how this unfolds. I think a big chunk of this, if we take a look at the Magnificent Seven, they are kind of holding their ground. They are really just... they're not budging at this point. So whichever way they break, and you can see we're getting closer into this, it's coiling a little bit. So it's building up energy. When things get to the apex, which they get squeezed, usually it becomes very random. Generally, when you see the market go up and then it starts to create a coil, you generally want it to break out and run before it actually coils into an apex. As things go into the apex, it means there's indecision. And from this point here, because things get narrow, it could do a fake out, it pop a little bit higher short term, get people bullish, and then reverse and go the opposite direction. Or it could shake down first and spook everybody out and then take off. Generally, we don't want something to get to the apex because it just makes it's a random play. It's easy for it to break in either direction and fake you out or shake you out. We usually want something to run up, have a little bit of a hiccup, and then just keep on going, not coil into a point, a pennant formation. Although it is still technically a bullish pattern, generally you don't want the pennant to go right to the apex, the point. Anyway, let's take a look. Whichever way the mags are going to break is probably which way the stock indices are going to go, and we just have to let that unfold. So today we're seeing money more or less mixed in the markets. It looks like a real pause day. The dollar's flat. Gold and silver are relatively flat, although gold did sell down last night. It was down over 1% at one point, came down towards the 5-day, and it's had to bounce back up. Again, it is in that phase right now where everybody's kind of moving into it, and every little dip is going to get bought up until there's an overwhelming amount of people selling. Yesterday, it did hit our target right up here. We talked about that 40.80 and that 40.100 level being that Fibonacci target. The price gapped up for our ETF. We got a really nice fill on that trade. And now technically, it doesn't really matter what it does at this point. We just let this do its thing and work itself out. We do have the highest volume we've seen in a while, so it'll be very interesting. A lot of people always wonder, like, we use Fibonacci extensions. So this is the nice thing about Fibonacci extensions is we can see what I call invisible resistance areas. So a lot of people will think gold is off to the moon and it's picking up speed, but because we have Fibonacci, we can put these invisible resistance areas where it's going to run into some selling, and that's really what we pretty much saw yesterday. We saw price come up, tag this level, and now a little bit of selling came in, and then we'll see if it gets some more selling and puts in a pause here before it goes any higher. If we take a look at the chart of bonds real quick, again, they've popped up. It's kind of flagging sideways here. The big question is it going to have a little ABC correction and come down a little bit more? Or is it going to want to start and just turn up and run and start to move higher, which would bring us up into this resistance level up here and really kind of start to carve out what looks to be more of a significant bottom on this chart. We could argue if it has that measured move, it'll start to put out what looks to be a little bit of a bottoming formation through here. Now, obviously, there's a lot of work to be done. This is a smaller pattern in an overall much larger base. If we were to just draw this back, the size of the bear market phase, I would say this would be the early stage of the base, to be honest. It'd be kind of down through here and work itself up. And when it starts to break out, that'll be fairly significant. And then, of course, we'd also have this level here being another significant level. So there's a few different, this is the first one, and then we'd have the second one. And if it can break through here, then I'd say the whole rounding formation would be complete. And then we could see this start to move up. Obviously, there's some upside potential there, but it's still in this lower bottoming kind of zone, and I wouldn't get too excited just yet. If we take a look at the hot list, again, the top performers are continuing to be the same: silver miners, copper miners, clean tech, marijuana space, gold miners, lithium, metal miners, base metal miners, silver, uranium, the ARK ETFs, blockchain. So there's no doubt it is the speculative space is on fire. As we talked about with the comparison of 2007, this was the 2007 peak in the stock market where gold ran up. Eventually, the stock market sold off and did a 55+% correction. The part that we're looking at here is with the crowded play in the precious metal space, where suddenly everybody piles into miners. And then we start to see people piling into platinum. We start to see people pile into palladium. Well, if you look at where we are right now, very similar situation. Again, even the dollar was low. We have the dollar low. We have a similar gold and stock market setup. And we have everyone piling into miners. We have everybody piling into platinum and into palladium. So we are definitely seeing very similar chart pattern unfolding. And what happened after that, when we look at the overall markets, if we were to zoom out, you can see the stock market eventually sold off and went off a cliff. Gold should continue to push higher for a bit longer of a defensive play, but eventually gold will pull back with the overall economy kind of potentially changing gears, and this more so the selling in the stock market. But there's potential gold might hold its ground fairly well given the environment. But again, typically when we have a big financial crisis like in 2008, it's the same feeling. You think it would hold up, but it doesn't, because financials were falling apart, and gold still gets pulled down just because of liquidity, forced margin calls, fear, and just selling pressure in general. If we look at our sentiment chart for the NASDAQ, but this is the same for the S&P 500, we are in this phase here where big money has been and is rolling out of the stock market. As we've seen, the stock market's been grinding higher, but the mags aren't moving. And we saw that kind of actually happen over here. We saw the stock market moving up and the Magnificent Sevens were pretty much flatlining. And then, of course, we saw a big event. And usually the technicals, if you've been following me for a while, you'll realize the technicals usually are warning of something happening, and then the news hits, and we have this type of move, and people will say, "Oh, you see, you got to follow the news," even though you don't have to. You know, the technicals and the price action are warning us that stuff is happening, that something big is about to take place, and that's the nice thing, is we're mentally prepared. This market will eventually roll over, and we're going to have something bad that's going to create the next pause and pullback and sharp correction. And then just the big question is it a correction? Or is it an actual kind of crash / real bear market, a stage 4 decline that could take years to recover from once the unwinding in the AI space kind of takes place a little bit in the Mag 7s fall. And the Mag 7s, keep in mind, Mag 7s and NVIDIA are such a crowded trade, and they're so heavy weighted that when the masses, the emotional masses who have just been chasing, and if you're in it, you're doing exceptionally well right now. But once it does change and start to collapse, just as they're a feeding frenzy to the upside, it is a mass panic and exodus to the downside, and they just kill the stock. Emotional traders make things go parabolic, which is not healthy to the upside. They also make things go straight down, and the markets fall 4 to 7 times faster. So when you have a whole whack of millions of investors who technically don't really know how to manage positions, and they just panic out, and they're driven by fear of missing out, and then they're driven by fear of losing more money, it's going to absolutely kill the stock market. And it doesn't matter how strong the earnings are for NVIDIA. This is what I learned in the tech bubble. It doesn't matter how strong the earnings were. In 2001, I was holding the strongest growing companies in the stock market quarter after quarter, and they got hit with 50% corrections like it was nothing. And so I don't really care how strong NVIDIA's growth is and their profits. When people start to sell, we will see this thing absolutely dive bomb. Maybe not that low, but we will see it sell off just because price goes up when people are greedy, price tanks when people are fearful. And that is going to pull the entire market. And so this huge run higher is driven by people into the most powerful index moving stocks. And when they start to sell, the indexes or indices are going to get hit. So anyways, that's it for now. We'll see how things unfold and go from there. Bye-bye.